Hello, everybody. I'm Christopher Phillips, the co-founder of the nonprofit Democracy Cafe. Our signature initiatives are Democracy Cafe, the Global Grassroots Socrates Cafe, and also some others ones around the Constitution. I had this sort of series of mini offbeat constitutional conventions that were called Constitution Cafe, and that has morphed into our annual conversation with the Constitution that was the brainchild of Paul Martin, who is also the CIO and founder of Martin Capital that you can read all about on martincapital.com, and for which I am an investment advisor representative. Paul, welcome. We're going to do the inaugural Compass Cafe, that's based on a little bit on the quarterly newsletter that's released called the Compass. And you have here's the newest issue, kind of hot off the presses. And Paul, you've been coming out with this newsletter for a long time.
Yeah, since 1991, beginning of 91. Yeah. So, and they're all on the website, martincapital.com. So,
But it still reads fresh.
yeah, well, it's, I have to admit, sometimes I get it wrong, but usually I get it pr pretty close to kind of what's going on.
Uh-huh.
But yeah, it's fun.
So today is September the 11th. It's the 24th anniversary of the attack on World Trade Centers and elsewhere. And I wrote about in my book, Soul of Goodness, that I had a cousin who was working on the 104th floor of Cantor Fitzgerald that day in the World Trade Centers, and he perished in that. And it made me think for the first time today, Paul, that maybe there, in some inchoate way, I was influenced by that, and more so, of course, than anything, by you to become an investment advisor representative. And one of the reasons and stories that is that what you did following those attacks, you did something that I felt like was a consummate act of patriotism at a time when everybody was dumping, selling their stocks, selling their assets. You did something. I don't know if you want to talk about it, but I thought it was really amazing.
Well, why don't you start the conversation?
You decided you had an option of not buying a house, of pulling back on it. And you decided, you know what, at this moment, our country kind of needs people to be all in with our economy. And
Yeah.
so you move forward with it at great risk and probably great loss.
Yeah, it definitely cost me some, but yeah, I actually met with an attorney on the Monday. I think 9/11 was on a Tuesday. On that Monday, I'd met with an attorney to talk about canceling the contract. It was going to cost me some money, but that's business and that's how it works sometimes in real estate.
Mhm.
And uh, and so we were making arrangements for that, and then 9/11 happened, and I said, I got to buy the house. I mean, I don't have a choice here. I got to buy it. And
That is as counterintuitive as it gets.
oh yeah, no, it was the perfect excuse for me to be able to get out of the contract because I had a reason. I mean, it's like, hello, I have an investment management business, and who knows where the heck things are going. And you know, but as you said, I just felt like, if everybody pulls back here, the terrorists win, and I'm not going to let the terrorists win. So I did finally sell it. I think I forget how long it took me. I did move in fact, as well for a while. I finally sold it. I think like a year and a half later. So
But that was an incredibly, I would call it patriotic at that time because it went against the grain of everything that everybody else was doing.
yeah, yeah. No, I get into situations like that where I just I got to do the right thing here, and it's not so good for me, but it is what it is.
And you have an investment advisor. I mean, people would think you're the last person on this planet who would do something like that. But money does not, as brilliant as an investment advisor that you are, I consider you a maestro. You still in your personal investment realm, you'll take these sublime moves, if you think it's what's good for society, that are very unique.
Yeah, as I said, it gets me in trouble all the time. So I can't stop myself.
Oh, so here we are, 14 years to the day later since those tragic events. And there have been some moves made by our president since Trump resumed office on January 20th uh, that reminded me, some of the tariff moves, especially, and others, of the sort of Smoot-Hawley Act that was one of the factors that arguably led to the Great Depression that my father grew up in shortly after his family immigrated from Greece. But you're not sort of, I mean, if we go through all the white noise and stuff, policy like that doesn't necessarily have much impact right now because of the kinds of checks and safeguards we have on Wall Street.
Well, I'd learned many years ago it's all about the Fed.
It's
People,
all about the Fed.
yeah, people focus on things that are happening, what the president's doing, what's happening in the Middle East, things like that, and even 9/11 for that matter. Um, People forget 9/11. We were back to the old highs by November after 9/11. What caused the market to roll over again
That
was,
soon.
yeah, these are real numbers. You can look up the S&P 500.
Wow.
It took a couple of months to get back above where we were before 9/11. And the problem was that the president decided to invade Iraq, and that build up to the invasion in 2002 caused the market to roll over again. The market does not like the build up to wars. The market's fine with wars. The war starts, and you see that in many wars. In fact, that happened in 2003 when the war started. The market took off from there, and we never looked back. Um, but the buildup, there's that uncertainty about when it's going to be, how many casualties, just all these other factors. And I still remember people kind of scratching their heads in 2000, at the beginning of 2003 when the war started, and the stock market shot up that day with the shooting starting. And
Hmm.
the again, it was the beginning of the war, and the market's like, okay, we're finally doing it. We're going to get it over with. Let's look past this and move on to the future. So, yeah, th that was the frustrating thing, was that long build up to the Iraq War, which, of course, as we know, and may have some listeners that don't agree with this, but the fact of the matter is, Al Qaeda was in Afghanistan, and and the Taliban are still there. But and Saddam actually hated the Taliban and the whole group that was involved in the attack. Um, but it gave the excuse to take out Saddam, which I guess a lot of people had wanted to do for a while, but it did hurt the markets and
Hmm.
was unsettling for a while.
Hmm.
So the bottom line is that markets are affected by the buildup to wars
Hmm.
that can have a fairly significant
Hmm.
impact, but that doesn't, it's not as significant as the Fed. The Fed really is the one that has a long lasting impact, where you go for 10 plus years before you get back to new highs.
Hmm.
As we saw in 2008, uh, took us, I think, till 2013 uh, to get, well, let's see, maybe 2015. At any rate, I don't have the numbers right in front of me, but I've done a lot of research on this, and when the Fed gets too tight for too long,
Hmm.
it's not going to be pretty, and that's what happened in 2008. They first they got us too tight in 2007, and my indicator uses the 1 year T-bill against the effective Fed funds rate, which nobody
Hmm.
else looks at, but it's when the 1 year T-bill is 20% lower, the rate is 20% lower than the effective Fed funds rate for more than 2 months. It's time to get out of the way because it's not going to be pretty. So we have options set up to be able to hedge if and when that happens again, which it will at some point. But
But
we
you've
got
done
there.
massive research to get to that conclusion. This wasn't
Oh yeah,
something that was just
no,
some,
it's all in the numbers, and the numbers
right.
are out there. The numbers, the Fed has actually numbers going back to 1953 that are very accurate regarding a number of things like the S&P
Mhm.
500, CPI, and so
Mhm.
on, and obviously the Fed funds rate. And
Mhm.
so in my analysis, that's what I figured out. It started out with I don't know if this is getting too much detail, but it started out in 2007. I think I've told you the story when I was in Washington, D.C., waiting for a flight to come back to San Antonio and sitting at a table, had a sandwich, and this guy comes over and asks if he can join me because all the other tables were full. And it turned out he was the director of research of the Chicago Fed. He'd literally just come from the Fed meeting where they'd cut a quarter point that day. And it was their second cut. This was in October of 2007, top of the market, and just before the recession started, and just before the market, really began to roll over into that massive bear market that we had in 2008. And we were visiting, and we said, "Yeah, we're a little worried about the economy, so we were cutting rates." And I'm like, "Well, do you realize that you have a severe yield curve inversion?" And he was like, "No, I wasn't really looking at the yield curve." And he acknowledged that yield curve inversions are negative for the economy, but he hadn't really been tracking it. I said, yeah, I mean, it's severely inverted. In fact, instead of 25 basis points today, you should have cut 250 basis points, 10 times what they cut. And he got a little upset at that because his attitude was, well, that would scare the markets. And I'm like, well, would you rather scare the markets for a few days or destroy the economy? Because
You
that's
said
what
that to him.
I said that to him. I said, that's what you're doing right
Oh, I'm
now.
sure he was really appreciative of that.
Yeah, he was not happy. We kind of at some point just agreed to disagree.
Socrates comes into his life. The Socrates of investors.
Yeah, yeah, yeah. I mean, it was kind of a little bit of Socratic dialogue because yeah, my first question was, um, do you think yield curve inversions are bad for the economy? And he's like, yeah, I agree. I'm like, okay, well, here's the deal.
Mhm.
This is what's going on. And uh, and the problem is they didn't get it because they kept cutting rates very gradually, and the interest rates in the rest of the market were going down much faster. So
Mhm.
they would cut 25 basis points and the 1 year T-bill would go down 35 basis points. So
Mhm.
the inversion was even worse. And so by May of 2008, well into the recession and the bear market,
Mhm.
we had the worst inversion on record going back to 1960, 1953, which was a 60% inversion of the 1 year T-bill to the effective Fed funds rate.
Mhm.
That's the market just screaming, you guys
Mhm.
are insane, with your rate at this point. And
But they're deaf. They
well,
fell on deaf ears.
they don't get it. They don't look at the numbers and they don't get it. And so then I decided I didn't want to go through this again. And so I wanted to figure out, how to manage it. And I was talking with Chris. Uh, let's see, not thinking of Chris's last name now.
Martin?
Keith Phillips. Keith Phillips. Um, uh, Here, who at the time was a senior economist for the Dallas Fed, but
Nice.
in San Antonio. And after an event that he'd spoken at, and we visited a little bit, and we talked about the yield curve, and he was like, "Yeah, the yield curve is a good indicator." And so he actually put together a presentation called "The Predictive Powers of the Yield Curve," which shows that yes, every recession going back to 1953
Mhm.
has been led by a yield curve inversion. You don't
Mhm.
have a yield curve inversion, you don't have a recession. I don't care what's
Mhm.
going on in the Middle East. I don't care what
Right.
the president's doing, whatever. You don't have a recession. You got to have the yield curve inversion.
Mhm.
So then I thought, well, all I have to do is start hedging anytime there's a yield curve inversion. But then I'm a data guy and I look at the data, and 2/3 of the time during these fairly mild yield curve inversions,
Mhm.
stock market still goes up.
So even during some yield curve inversions,
And
that's
and
not in and of
recessions,
itself.
right? During some recessions, mild recessions
Mhm.
that are caused by mild yield curve inversions,
Mhm.
um, stock market does okay. And so that was eye-opening for me. So then I thought, okay, so what's the deal here? So then I thought, okay, let me look at these really bad recessions and bear markets. All of those were, in fact, caused by severe yield curve inversions.
Mhm.
Again, this greater than 20% inversion on the 1 year T-bill to the
Mhm.
effective Fed funds rate for more than 2 months. Um, and without that, you just don't have bad recessions and bad bear markets.
But this
And
took massive research.
Not really massive. It's just a matter of putting together spreadsheets and
Over
going.
decades, though, right?
Yeah, but the data we were able to download from the Fed.
I
Uh,
see.
Chris Martin helped with it and got the spreadsheets together. And then I just kind of spent a lot of time going through spreadsheets and looking at the numbers. And the numbers are there. Anybody can look it up if they want to. Um, but uh, but the bottom line is that yeah, we do get these occasional times where the Fed is just too tight for too long, and they're
Mhm,
oblivious
mhm,
and they don't seem to understand the powerful relationship between the yield curve and the
mhm.
economy. Even though,
And they're the Fed.
Even though as Keith Phillips figured out, every recession since
Right.
1953 has been led by the Fed being too tight with the yield
And that
curve.
seems to be a running thread through your newsletters over the years. And yet I feel like if I knew somebody with the Fed, I would be showing your newsletter to them.
They don't want to hear it. They don't care. They're the Fed. They know what's going on and whatever. And so but it is something that I've set up as an indicator, and we do. I did talk about it in our newsletter last August that there was the potential that we would have a severe yield curve inversion, and we did. We got down to a 20% inversion in August for a little bit, and then the Fed cut 50 basis points in September, and we got out of it, and
Mhm,
we're okay. But it came close. I was getting kind of nervous.
mhm.
So,
But you've got your clients covered.
well, I mean, yeah, the idea is to hedge, like basically with the option hedge, it's like buying car insurance. You know, you hope that you're wrong, that you don't have any accidents, but at least hey, I have an accident, I'm covered. And that's kind of the way this option strategy works, is that there's a cost to it for the
Mhm,
hedge, but you know what your downside is. And you still have unlimited upside because you're still fully invested, but
mhm,
you're just giving up in terms of your performance, the cost of the hedge
mhm,
against the market. So if the market's up,
mhm,
20% and you're performing in line with the market and your hedge is 5% of the portfolio value, then
mhm.
you're up 15%.
Right.
On vice versa, if the market's down more than 10%, then you're hedged against that and you
Mhm.
don't lose any more than 10%.
Right. I mean, I wish people would also listen to you because I feel like some folks like Paul Volcker have been unfairly vilified, that they
Mhm.
look at interest rates and things and connect that in ways that actually aren't true. And he still needs to be somewhat rehabilitated after all this time.
Well, I've talked about that many times, and I know I've talked about it with you. And yeah, the story there is everybody talks about how tough Volcker was and how much he raised rates. Well, he raised rates in line with the 1-year T-bill.
Hmm.
And so he never severely inverted the
Hmm.
1-year T-bill to the effective Fed funds rate. And
Hmm.
so during his 8-year tenure running the Fed, uh, we had one down year in the S&P 500. It was
Hmm.
1981, down
Hmm.
5%, and we had a recession that year.
Hmm.
We had two mild recessions basically under Volcker. Then we had another recession in 84, and the
Hmm.
market was up 20% that year.
Hmm.
And at the end of his tenure, the market was up almost 300%. So I'm not quite sure how he destroyed the economy and the stock
And
market.
yet, that label has still stuck with him. Paul, I'm wondering, you know, as we get news almost instantaneously these days, moves to oust Fed members, moves to oust the Fed chair if he's not doing what the commander in chief wants. Should people worry about that, that the Fed is no longer going to be independent, autonomous, or is that also not such a worrisome issue?
I'm not too worried about it. I mean, the fact of the matter is the Fed often errs on the side of being too tight for too long. Um, and that's what really hurts the economy. I mean, don't get me wrong, high inflation is, a problem, potentially. But if I had to choose between high inflation and a severe depression, give me the high inflation every day of the week.
I think that's an important lesson that I probably it's counterintuitive to a lot of us folks.
Yeah. Yeah. I mean, if you got high inflation, well, there is justified to some degree because people are making more money and stores are able to charge more for their products and
Mhm.
the economy is doing all right and that's how it works. And admittedly, it's frustrating to every day you go into the grocery store and prices have gone up for stuff, whatever. But
Mhm.
uh, but at the same time, you're still able to buy stuff. You go into a severe depression, you can't buy anything. You know,
Hmm.
you need to, go find,
Hmm.
someplace that will give you food and that type
Hmm.
of thing. I'm talking about, poorer
Right,
people, if you will.
right,
Um, but so, yeah, n nobody talks about that. It's like, well,
right.
okay, if your choice is a severe depression, you know, millions of people out of work, uh, devastated economy, or watching prices go up every day. Yeah, I'd rather
Hmm.
watch prices go up every day.
Right. Well, that leads to another thing about employment. A lot of articles in the Wall Street Journal, in particular these days, are about how artificial intelligence is leading some of the big tech industries to make massive cuts among their workforce. How do you think that'll play out over time? Are there some positive sides to it?
Well, I mean, theoretically, AI, makes business more efficient, the operations more efficient for companies and what have you. And part of that efficiency is not needing as many employees, potentially.
Mhm.
So,
But it could generate lots of new things.
yeah, it could generate lots of new things. I think the jury's still out on that one. I
Hmm.
think there are a lot of theories out there about where that's going to go, but I think that um, I think it's a positive thing ultimately.
Hmm.
But as with any positive thing, there are going to be some negatives too.
Hmm. These are exciting times to be alive.
Yeah, yeah. Well, what's the quote? The curse, I guess. May you live in interesting times.
That's, I want to ask you, well, what would your doppelganger say, essence, about that?
Oh, yeah. Good question. Uh, yeah.
I need to tell my audience that Paul and his brother Jim are philosophers, and they have come out with this incredible collection of aphorisms. All of us were snookered into thinking that it was these were pre-Socratic philosophers. It was so well done, and that you and Jim have a book coming out that I really look forward to seeing what springs from your philosophical.
Yeah, hopefully we just about have the final draft, so we'll see. And thanks for your help on it, Chris.
Oh, it's my pleasure.
The
You snookered me.
yeah,
I thought
yeah.
you guys, I couldn't believe it when I thought I was Mr. Hellenic Greek. I knew all the pre-Socratics that my yaya had taught me about, and I'm going, well, who are these guys? I couldn't find you. It was amazing to realize there was two brothers, and an endeavor that has brought them together somewhat. But we're going to have to do an event in December when I'm out there about that. And I look forward to seeing you when I'm flying out to San Antonio to be part of a in-person hybrid gathering of our 13th annual Conversation with the Constitution. This one's, no matter how many or few show, it's going to be amazing and very timely on focusing on the Fourth and Fifth Amendments of the Constitution. And somehow I feel like, Paul, your investing strategy and everything that you do in the philanthropic world, including our conversation with the Constitution, that somehow it's all entwined.
Yeah, yeah. That's yeah, ultimately though for me it's psychic automatism. It
It's
just
on your LinkedIn page. I'm like, people must go, what in the world?
automatic mindfulness. Yeah, so
Where did that
and,
come from?
and I should mention that a conversation with the Constitution, we want to let everybody know it's free and open to the public. It's going to be here in San Antonio, as you said, on Wednesday evening, and
At the Radius
at the Radius, which is
Auditorium.
near the Tobin Center. And
Yeah.
I think, let's see, we have where do we have it online? We have it at Art by Paul Martin, my website. You can people can look it up there if they want to check it out. Of course, obviously, they can be in touch with us about it too,
Mhm.
if they want to get more information.
Well, it's such a meaningful event, and I look forward to seeing you soon. And Paul, thank you for doing this inaugural gathering of just me and you of Compass Cafe, and I look forward to the next one.
Okay, thanks, Chris. Yeah.
Thank